We're doing it again. Today, we are reacting to more cringeworthy insurance TikToks. There's just too many of them, and I can't help myself, and they're so bad. So yeah. What is up, guys? For those of you new to the channel, my name is Philip Sutter. I'm the founder and CEO of Affinity Life, where we've helped hundreds of Canadians find the right life insurance coverage at the right price. If that sounds interesting, I'll put a link in the description below and you can check it out. But without further ado, let's get right into this video. Side note before I get started here, every time I look up life insurance on TikTok, the very first video that always pops up is insurance secrets only the rich know. And I'm just like, oh my God, fuck my life. This is what I'm dealing with.
Whole life insurance explained in 60 seconds or less. You ready for it? I put 10 grand in, okay? Take $10,000, I put it into my whole life insurance policy. Year 2, take 10 grand, put another whole life policy. Year 3, 10 grand in. Year 4, 10 grand in. Year 5, 10 grand in. So I put $50,000 into a whole life policy. And now I say, James, I want to take out 50, but I only got 30. So where'd the other 20 go? The other 20 went toward your insurance for the rest of your life, depending on the policy. Every year after, for every 10,000 I put in, I'm getting 10,000 put directly into my cash value, plus dividends. It's a participating whole life. But the beautiful thing is this. Let's say 7, 8, 9 years, I got 50,000 sitting in my cash value policy. I'm not actually taking the 50 grand out if I want to go buy a property. I'm actually borrowing. So the money stays in there. The dividends keep coming. The interest keeps coming as if I never took the money out. And when I die and I still owe this 50 grand plus interest, all it does is come off.
Yo, that actually, to be fair, that guy just did a really great job at explaining whole life insurance. I mean, he didn't say like who this could be right for, but I mean, that's actually a really good explanation for how it works. Here's a quick thing actually though. I mean, he mentioned that like, okay, you're not going to have $10,000, you know, you put 50 in, but there's only 30 there. There's different ways that you can structure permanent life insurance, specifically whole life insurance. And I explain it like this to clients. Okay. So imagine you have two sides of the spectrum. On this side right here, you have max death benefit and a lower amount of cash surrender value. Okay. And then over here on this other side, we have a smaller death benefit, however, a significantly higher cash surrender value. And then anywhere on this imaginary line, you can structure your whole life insurance policy. So you can structure it exactly kind of like he said, you know, maybe you put 50 or 60 in, but you only have a cash surrender value of 20 or 30, and the rest of it exactly goes to that death benefit. So you have a high death benefit. However, you can actually structure whole life insurance in a way where you have less death benefit. However, you'll recoup your cash surrender value, like money put in versus what's in there in a cash surrender account, pardon me, by like year 3 or year 4. You can structure it so like almost right away you have all your cash surrender back, and then it's growing year 3, year 4, year 5, and it starts to take off from there. However, you do sacrifice some of that death benefit. So, you know, it's really good to talk to your advisor when you're considering this type of strategy to think like, okay, where on this spectrum do I want to land? Do I want to have more death benefit for my children when they pass away, or do I want to really utilize this as some type of investment? And by the way, if you're new to my channel and you don't know my stance on this or my opinions, I have a ton of videos on this type of subject, you know, investing in life insurance. I think it can be a great idea for high income earners and business owners. However, for the vast majority of Canadians and Americans that are the low to mid income earners, I don't think it's a great idea, and you should focus on other traditional strategies instead.
So as of right now, I've got about $30 million worth of death benefits. So if I passed away today, my daughter would get about $30 million. It's a bad look for a 15-year-old. So I've got trusts in place that dictate how that money is spent. When I pass away, instead of her getting $30 million, it's trickled down to her, and the money has to go into a properly structured policy. So think about that. Death benefits are tax-free. So the money is tax-free going to her into a policy that grows tax-free. And then it's trickled down from the trust. When she passes away, it has to do the exact same thing to her heirs. So my family will just get wealthier and wealthier and wealthier tax-free generation after generation because of how I set the trust and the life insurance up.
I like how he's just getting like a haircut. Like, I want to know how this even happened in the first place. Like, did he like talk to his barber and he's like, hey man, I want to shoot this life insurance video. Can I come and get a haircut so it looks like I'm so busy that I need to film my videos while I'm getting a haircut because I have no time because I'm ultra wealthy? Like, how did this video come to be? It's so random. But yeah, I mean, like what he's saying is legit. Yeah, live in trust for your children so they don't spend it all at once, and you can dictate how they use the life insurance proceeds. That's legit. Buying lots of policies to pass on, that's legit. Yeah, why you should study the ultra wealthy? Keep in mind, the ultra wealthy are doing things that low to middle income earners should not do, because at that point, their marginal tax rate is so high, they need to look at alternative investments that are different than other investments that would traditionally be just way better for, people making 50, 80 grand a year. So that's not to say that you should duplicate or replicate what ultra wealthy people are doing. It's different strategies that are better for them because they pay such high tax rates. You already, if you're a low or middle income earner in Canada or the United States, already have access to so many good strategies with so many less strings attached. So yeah, it can be a good idea to get some life insurance in place. However, using permanent life insurance as an investment and buying I think he said $30 million of coverage or something like that, that's not applicable to every. I run my business a little bit differently. I guess educating clients, I make YouTube videos. Meeting with clients, I guess I do phone calls or Zoom videos. I don't have an office. I had an office for a long time. I think I had an office downtown for 5 or 6 years. And then when COVID happened, obviously our way of working totally changed. And my business completely transitioned to what it is today, which I really love the direction that my business is going in because it's way less face-to-face meetings, way less phone calls. I do a lot of upfront work by educating clients through this YouTube channel. And of course, I spend a lot of time on this YouTube channel. However, it's nice because I can, have a conversation a couple different times on a video like this, and a lot of people watch it, so I can duplicate my efforts as opposed to having the exact same meeting every single time with every single client. So it's just a little bit easier. I mean, I guess it depends how you want to run your business. I really enjoy how I structure my business because I can be in a lot more control of my time, and I don't have to be so dependent on, when people can meet. I can do a lot of the upfront legwork through this YouTube channel and other variables that I have.
You should really get life insurance in case something happens. Are you sure? I'm only 18. The chances of me dying are pretty slim. Well, what if something does happen? You'll want to be protected. Hold up, I know that life insurance is only needed if someone is dependent on my income. So if I had a spouse or a kid that was dependent on my income, then life insurance would make sense. But I'm 18 with no spouse and no kids and no one's dependent on my income. I don't want your life insurance. Dang it. How'd you know all that? Because I follow Johnny Finance.
Let's go. Yes. If you guys followed my channel, pardon me, for any amount of time, you'll know that I say this exact thing. And I post everything that I create on here also on LinkedIn. And I always get a bunch of advice because I have a ton of advisors and connections on LinkedIn. And they'll always be like, well, you should buy permanent life insurance just because you'll need something later on in life. And you should buy term life insurance when you're young because, you never know what's going to happen. It's just no, dude, just relax, man. There's more important things in life than life insurance. I know you as a life insurance agent cannot think objectively past selling life insurance because that's your entire job, but there's other things in people's life that they don't care of. The life insurance isn't the top of the priority list for everyone. So John Finance, if for some reason you're watching this, thank you. Thank you for being the one TikTok that I actually 100% agree with. I don't know about the rest of your channel, but this one specific one, you nailed it. Thank you. Thank you. Thank you. Thank you. Thank you. My faith in humanity is restored.
My thoughts are that whole life insurance is not a mechanism for building wealth, and anyone who tells you that it is will earn a commission if you purchase a policy. If you really want to understand this, go spend 12 minutes to listen to this podcast episode. They break down the difference between term and whole life insurance. Now, whole life insurance is what people try to sell to you as a wealth building product, and that's because there is an investment component to it. Now, depending on the type of whole life policy that you buy, your money will either be invested in a money market fund or bonds, which we know don't really earn you any money. Or it can be an indexed policy, so it indexes something just like an index fund would. Even if you have this type of policy, your returns are still going to be muted by the fees of the company and the commissions for the agent. They try to sell this to you as something that returns more than the market with less market risk. A product can never give you more of a return than the underlying fund, or the company would go out of business. The structure of these policies are also so confusing, and most people who open a policy like this don't completely understand the terms. You're much better off getting a term life insurance policy, which will have a significantly lower monthly premium, and then investing the difference. But definitely go listen to the podcast episode. It is worth 12 minutes of your time.
I mean, okay, hang on. Okay, first, let me say I'm happy that I'm on TikTok right now and I'm not watching these like cringy, look what Waka Flocka is buying $30 million of whole life insurance. Look at what this NBA player is doing. So first, I want to say that's awesome. And I haven't listened to this podcast episode, and maybe I'll go and take a peek. However, I mean, what she's saying is true to a certain degree. And anyone that follows my channel for any amount of time knows that like I'm a huge advocate for term life insurance and buy term and invest the difference. However, I understand and I cannot argue with the math. Here's the thing, is like mathematics is quite simple. You just look at all the variables and you look at the numbers, you look at the Excel spreadsheet and you can see, and like no one can dispute the fact that for business owners and for high income earners, whole life insurance is a viable option that you can build wealth through. You can't argue it. The numbers do not lie. You cannot argue with the numbers. So when she's saying a blanket statement, I don't 100% agree with that, but I do want to say this is awesome that there's more type of content like this on TikTok that's not this cringeworthy like, hey, look at this person buy a permanent life insurance policy for as little as $100 a month, do what the rich are doing, because it's so cringy and I don't believe in it. However, only the Sith deal in absolutes, and she's kind of dealing in absolutes and saying that like it's never a viable option, which it is a viable option for specific people. You know what I'm saying? Anyways, but good. I'm happy. I don't want to take away from the fact I am happy that there is some more of this content on TikTok.
So the first investment that he mentions is whole life insurance, and I couldn't agree more.
Well, look at this
Let me show you
diagram.
why. In this example, let's compare term life with whole life
Whoa.
insurance. Here we have term life,
Look at
$1 million
this.
policy.
You put me on an island with a sheet of paper and a pen and told me the only way off that island was to draw something as neat as this. I would die on that island. I cannot draw worth anything. I'm so bad. So this is a very good drawing.
Per month for 20 years, but a whole life policy, $1 million coverage, starting at 30 years old, $837 per month for the rest of your life. Now, there are 4 main components to a whole life policy: the agent, the premium, the cash value, and the death benefit. The agent in this example gets a very high commission, which on average is 1 year of your monthly premium, which is about $10,000.
Or more if you have an override as big as mine.
The monthly premium is going to vary by your age, health, and coverage. The cash value, which is what makes whole life different than term life, doesn't actually start accruing until 2 to 5 years after you pay your ridiculous premium.
Structure it within this line that I told you about, and maybe you go more over here and build more cash value. But it's okay. Let's see where she's going.
Which means you've paid about $25,000 for a $1 million death benefit that you could have got for $47 per month if your cash value doesn't start accruing for 2.5 years. And then again, in this example, your death benefit is $1 million, and that's all your family get when you die. It does not include your cash value, no matter how much.
How long did this drawing take? How long? I want to know. Honest to God. And also, what's up here? You see, there's whole life, IUL, and then there's something here that she erased. Why did you scribble it out? What is it? I don't know. And infinite banking. I swear to God, I could never draw this. I could never, ever, ever draw this in a million years. This is
It only includes the death benefit. But let's just say you didn't know this, and person A decides to do whole life. They die at the age of 85, and they've paid almost $500,000 for their family to receive $1 million when they die. But person B is very smart. They also die at 85. Between the ages of 30 and 50, they pay for term life insurance, which is around $11,000. And they also invest $500 a month at 7% between the ages of 30 and 85. So throughout their life, they've paid a total of $330,000 in their investment. But when they die, their family gets almost $4 million. It really doesn't get any more clear than that. The type of person that whole life policy works for is so minute that it shouldn't even exist.
No,
and the only people still selling it are the ones who get paid to.
She was so close. She had it nailed down. She had everything lined up. She had that beautiful graph. I've never seen a graph, a sheet that beautiful. In my entire life, I've never seen something that beautiful before in the life insurance industry. She was so close. She just had to bring it home right at the end to say there is a certain person that this could be applicable for. However, they're small. However, they are there, and it's not minute, and it's definitely applicable. Again, only the Sith deal in absolutes. By the way, so the diagram that she put, and she did all the numbers out there and everything, where she kind of like chose some things and broke down the math. There's more variables to consider than that. That's a very simplistic analysis because she's not taken into, there was no mention of taxation, meaning that somewhere in her diagram, or somewhere in her analysis, she picked and chose a tax rate that would make that specific equation look way better for the buy term invest the difference strategy. However, we all understand that tax is a variable that we have to consider. So you have to, when you do an equation like that, when you do an analysis of term life insurance, buy term invest the difference versus permanent life insurance, you have to take into consideration the variable of tax, because some people pay 20% tax, some people pay 50% tax. So what she just did in a diagram that's like kind of cute, and she did it in 2 minutes. I have a 45-minute video on my channel. And if you're interested in it, just drop a comment below and send me the invest in life insurance video. Or if you just go on my channel, you can find it, or just, put on YouTube, invest in life insurance, or is investing in life insurance a good idea? And I did basically the exact same thing she did, except I broke it down in different variables between an RRSP account, which is, we understand tax deferred, and everything that grows within it is tax deferred. But when we take it out, it's taxable. I also did it, if you look at what non-registered, I did it at different tax rates, at 20%, at 30%, at 40%, and I think I did 50% as well. And you can start to see the higher the tax rate you're in, the higher your marginal tax rate, the more and more beneficial this permanent life insurance strategy starts to become. So she was so close. She was so close. She was right there. I agree with a lot of things that she says. However, you can't deny the math. You just look at the numbers. This isn't like an emotional thing. Like, we have the numbers, like we can prove everything. You just look at the numbers and you can see, just play with the tax rate. That's the one variable that makes this specific strategy worthwhile. Higher tax, more valuable. Lower tax rate, less valuable. So if you're a high income earner, or you're a business owner and you can get access to special tax credits and tax deductions and tax strategies, I should say, not tax credits or deductions, but tax strategies within your corporation, then investment life insurance becomes such an applicable strategy. And like anyone that's followed my channel, you'll know that I'm not a huge advocate for it. However, only the Sith, the only absolutes, and I cannot lie that it does make sense in certain scenarios. Okay, guys, I hope that you guys enjoyed today's video. If you guys have any questions or comments, just drop them below. And if you guys are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next one.